The Federal Reserve just held interest rates steady, and it's no time to relax. This single decision kicks off a battle between a strong economy and probably rising inflation that will directly impact mortgages, loans, and everyday prices. But I will explain what this high-stakes conflict means for your money. Hi everyone, I'm George, a PhD economist, and today I'm going to break down the Fed's decision and what does the future hold. Also, stick to the end to understand how I predicted the decision and the outcome yesterday. For the fifth time in a row, the Federal Reserve just left interest rates unchanged, but this isn't a story about inaction. It's about the central bank walking a tightrope. So let's break down why the Fed made this call, what it means for the market and your wallet, and the high-stakes guessing game to come. To understand the Fed's decision, you need to see the two powerful opposing forces in the economy. On one hand, the economy is running hotter than expected. After a slight contraction in the first quarter, the US economy bounced back in the second quarter of 2025, with 3% annualized GDP growth, beating most forecasts. The labor market also remains solid with a low unemployment rate, but on the other side, there is the nagging problem of inflation. The annual inflation rate hit 2.7% in June, still stubbornly above the Fed's 2% target. Now, a new wildcard is in play: tariffs. The administration's trade policies are making imported goods more expensive, and Fed Chair Jerome Powell has acknowledged that higher tariffs are creeping into consumer prices. And this is a huge headache, as tariffs can push prices up and make the Fed's inflation fight much harder. So you have a strong economy you don't want to slow, and rising inflation you must control. What do? Faced with this dilemma, the Fed chose patience. By holding interest rates steady, they are trying to thread a needle, avoiding fueling inflation with a rate cut, while not tightening so much that they choke off economic growth. It's a wait-and-see approach. Jay Powell and the committee want more data to figure out if this inflation bump is a temporary side effect of tariffs, what Powell called a one-time shift, or a more persistent problem. The decision wasn't unanimous, however. Two Fed officials voted to cut rates, showing a real debate inside the central bank. This move also comes amid significant political pressures. President Trump has repeatedly called for rate cuts to boost exports. The Fed's choice to stand firm is a clear signal of its independence and its focus on keeping prices stable. So, how does this high-level decision affect you? The market's reaction offers immediate clues. The stock market had hoped for a rate cut to make borrowing cheaper for companies. When the Fed held steady, stocks dipped as those hopes faded. Meanwhile, the US dollar strengthened, with US interest rates at 4.5%, while Europe's holding lower at 2.2 to 2.5%. Holding dollars is more attractive to global investors. But a stronger dollar hurts US exporters by making American products more expensive for other countries, working against the administration's trade goal. For your personal finances, borrowing costs for mortgages, car loans, and credit cards will likely stay put for now. The interest on your savings account will also remain stable. The bigger question is how tariff-driven inflation will impact the prices you pay. One analysis suggests that the current tariffs could effectively cost the average American household thousands of dollars. And this brings us to the guessing game. The Fed is now in a reactive mode, forced to navigate the economic fallout from trade policy. This creates a classic central banking dilemma. If tariffs continue and inflation keeps rising, the Fed might be forced to raise rates to control prices. That would risk slowing the economy and increasing unemployment. If, on the other hand, tariffs significantly damage economic growth, the Fed could be pressured to cut rates for support. But doing so while inflation is still above the target could risk letting prices get out of control. Historically, central banks prioritize controlling inflation. Once it takes hold, it's incredibly damaging and difficult to reverse. That's why the Fed is being so cautious, even with a strong GDP report. This is one of the most complex environments the Fed has faced in years, caught between its mandate for stable prices and the unpredictable effects of trade policy. So, what do you think they should do next? Should they hold the line, cut rates to support growth, or raise them to fight inflation? Let me know your thoughts in the comments below. And now let me explain how I predicted the Fed's decision and the fall of US stock market 5 minutes before the decision was made. For that, let's bring the big boys here. So the very first thing that you have to understand is the efficient market hypothesis. This states that all available information in the market is depicted inside the prices. But I don't really agree with the efficient market hypothesis because there are so many inefficiencies that I have seen through the years, especially in the stock markets, in DAX, in FTSE 100, in the American Stock Exchange. So what I believe that is the most powerful is the real-time analysis. And as you can see here, this exact point is the moment of the announcement. But before that, you can see this double top here and here. Also, what you can see is the huge volatility that the market had slightly before the opening hours and in the opening 3.5 hours. So what this double top says to me is that investors are in the mood of, you know what, I'm gonna stay here, I'm gonna hold here. I don't know what's coming next. Then the other hint that I had was this push up above this point, violent push down. Push up, then again push down. And I was observing this chart about half an hour before the policy decision. I was about here and I was seeing this push up and this 5-minute candle that was suggesting a push down. So I was almost certain that this indecisiveness was leading to probably steady interest rates decision. Now this image is with respect to the Nasdaq futures. So let's go to the actual Nasdaq index itself. Here you can see again, double top here, push down, top here, push down, top here, violent push down in the 5-minute candle. And this is the moment of the decision. So why the market moved up and then violently down? See the exact moment that this happened. It was during the start of the press conference. The time you see here is my time zone in Greece. So when Jay Powell said that there is no clear decision for what to do in September and data will drive the decision, all investors pushed back and sold violently. Why they did so? We must see the picture since the previous announcement. So the previous announcement was on the 18th of June. It was somewhere here. And you can see that the market was pushing up and up and up and up and up. It was actually monetizing on the forward guidance that the Fed did. There, Jay Powell said that there will be 2 rate cuts within 2025. Back in the day, I was pretty sure that this one will not be the time for the actual cut, and September is the most probable time for the next cut. But the market was anticipating this move. So according to the efficient market hypothesis, when the central bank did the forward guidance, automatically the market capitalized on this probable next decision. Now that the Fed surprised the investors, they decided that they had very good prices since they started buying somewhere here. So it was a great time to capitalize on their gains and wait until the actual decision to buy back again. So this is the way that you should read the market data and the charts. If you would like to change to real-time commentary on ECB's or Fed's decisions, please subscribe and mention that in the comments below. I will do my best so you don't miss any market movement. Overall, the Federal Reserve's decision to hold the rate steady isn't a sign that everything is fine. It's a sign of deep uncertainty. The battle between strong growth and tariff-fueled inflation is just beginning. The Fed is trying to find the perfect balance, but with so many conflicting signals, its next move is anyone's guess. For now, all we can do is watch the data and see which side of the economic conflict starts to win. See you all tomorrow for the August economic outlook. Bye bye.